Hi and welcome to Swissquote's Daily Market Talk. It's Friday, November 8th. A week rich in decisions and events is coming to an end with fresh records in US equity space, fresh rate cuts from the major central banks, and fresh uncertainties that investors must deal with moving forward. So the Fed delivered a second rate cut yesterday when it lowered its rates by 25 basis points as fully expected by the market and priced in and out. And Chair Jerome Powell said that they don't rule out or in a rate cut in December, that the US economy is expanding solidly, that conditions in the US labor market ease but the unemployment rate remains low, that inflation in the US made progress, but not a further progress, just progress toward the committee's 2% policy objective, but remains elevated, that the Donald Trump policies won't have an immediate impact on the US fundamentals, as the Fed doesn't know how much time it will take the new Donald Trump administration to implement them, and that, well, he wouldn't step down if Donald Trump asked him to do so. And well, on a side note, and just because we were discussing about it in the comments in other episode of Market Talk, Trump doesn't have the power or interest in eliminating the Fed and make the central bank decisions himself. I mean, Turkey did that. They replaced their central bankers by puppets, and it went terribly wrong, to be polite. So the dollar TRY went from 1.80 when I first started working at Swissquote, well, that was 12 years ago, to over 34 today. But anyway, that ain't happening in the US. That's the good news of the day. The probability of another 25 basis point cut in December is given 71% in the immediate aftermath of the US election and the Fed's second rate cut. The US 2-year yield retreated yesterday after a Trump-led spike earlier in the week and is consolidating near the 4.20% level. The 10-year yield also eased from an earlier spike to 4.33%. But here's the thing. If US inflation doesn't ease enough, and if the US economy remains robust and the labor market remains in quite a good shape, then the bond vigilance, who actually think that the Fed is cutting too fast by too much, well, could step in, send yields higher, and there are rumors of a spike in the 10-year yield to 5%, and that would eventually destroy the positive impact of rate cuts and weigh on sentiment. So the Fed will have to dance with the Trump reality to the Trump's tune, whether it likes it or not, and that reality involves the risk of a higher than otherwise inflation and deserves the right dose of attention, in my opinion. But for now, investors are on a rosy cloud, to say the least. The market-friendly Trump has just won the US presidential election and is expected to lower corporate taxes and increase tariffs to make American companies dream big again. So the Federal Reserve rate cuts, on the other hand, well, came as another supportive factor, because this is what the Fed does when it doesn't know what to do, right? It just cuts rates, and the American stock markets are obviously flying on the news. The S&P 500 hit another record high yesterday, as in the Nasdaq 100, as did the Dow Jones Industrial Index, and the rally in the small caps in the US slowed on rising worries about the small companies' ability to carry this burden of eventually higher yields in the US on their little shoulders. But the mid caps, well, are thought to be a good alternative for those who actually think that the prospects of higher yields in the US on Trump makes the big caps look expensive at the current valuations. In the FX markets, well, the US dollar index bounced lower yesterday as the Federal Reserve's rate cuts gave quite a good reason to the market to correct and consolidate the latest gains. The euro dollar rebounded, but the upside remained capped near the 1.08 psychological resistance, and cable strengthened to flirt with the 130 psychological mark on the back of a hawkish rate cut from the Bank of England, but the gains in cable also remain challenged by strong offers near that 130 psychological resistance. This being said, the Bank of England has more reason to adopt a less dovish outlook than the European Central Bank, for example, at this point, given that the UK's new budget, which is calling for extra spending to boost growth in the UK, will also boost inflation by 0.5 percentage point, according to the Bank of England. As such, Governor Andrew Bailey, who had turned aggressive on rate cuts lately, didn't remain there too long. The Bank of England is now expected to keep lowering its interest rates, but gradually. And that shift from aggressive to gradual easing outlook is supportive of the pound, if, of course, the growth outlook for Britain doesn't deteriorate significantly. So, mid-130s for cable looks a reasonable target if the Fed insists on staying where it stands today. But as Bailey emphasized yesterday, the world has become a place with very big geopolitical shocks, and there are very big uncertainties in the world economy and the world at large. And the latter should continue to help gold to protect its place in portfolios. The yellow metal saw support at the 50-day moving average yesterday and should continue to be supported by haven flows, and also supported by sustained central bank buying as a response or as a preparation to the new Trump era. Over in China, the wait is long for investors who just want to see the Chinese authorities put a number on the amount of fiscal stimulus that they will deploy to counter the Trump shock. So the CSI 300 index rose yesterday on that hope, and also on news that Chinese exports rose to a 27-month high last month. But the European tariffs topped now as Trump presidency suggests that the country has better find a way to grow without relying too much on their Western partners. So investors are holding their breath today and praying that China will come up with a number, and a good one, to maintain appetite in countries' battered stock markets. In energy, US crude was better bid this week as news that OPEC would delay the end of its production restrictions by at least 1 month or more, and rumors that tensions in the Middle East could revive anytime were topped by that hope that Donald Trump would abandon the alternative and clean energy plans altogether and put all of his weight behind the traditional energy sources. For now, the barrel of US crude is still testing the major 38.2% Fibonacci resistance to the upside, so that's the Fibonacci resistance on the summer sell-off. A sustainable rise above this level still requires encouraging fiscal boost from China, because if not, the price rallies will likely remain interesting opportunities to sell the tops and keep their price of barrel close to the $70 per barrel level until a fundamental catalyst gives a fresh direction on either side. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will see you again next week. And until then, good day trading and have a lovely weekend.